Let's talk about a couple of other stocks then that are on focus today. And we have Deepak Shenoy as well that's joining in. Good afternoon, Deepak. Well, before we get to you, it seems the street believes there's a cement deal that's likely to take place, and the probability of that happening is high. And I say that because there's, there are board meetings that are scheduled today. JP Associates, JP Power, and Dalmia Bharat as well. For JP Associates, they're saying they're going to be taking the recommendations of the audit committee on board, and they're looking at the progress of various divestments. For JP Power, remember they housed the 2 million ton Nigri unit at Madhya Pradesh. So with regard to the sale of that, that's what they're going to be taking on board, the divestment of JP's Nigri cement unit. They tried to do it a few years ago to Orient Cement. It didn't happen at that point of time. And for Dalmia, well, they've said that they're closing the trading window because they like to take note of an event by Dalmia Cement. Just going by the coincidence, it seems, there could likely be a deal out here. To give you a couple of numbers, JP Group on the whole, their total cement capacity that they're left with is around 10.5 million tons. And their captive power is roughly around 300 megawatts or so, or a little more than that. Now, the street believes there could be a positive read-through for Dalmia. What if they take only the Nigri unit? That's a 2 million ton grinding unit. That will be a mild positive because it's not backed by clinker. It's not an integrated unit. But if in case they get that unit and that's opening up, giving them a foot in the door to go ahead and buy the other assets, that's what the street will like, because then they get access to JP cement units, which gives them access to central India, and those are integrated units. Remember, Dalmia Group has been talking about ramping up capacity from around 37 million tons to double it in the next 5 years or so. So it's a step in the right direction. Deepak, what's your take? These assets, in all probability, could finally get sold. Your view on JP Group, if at all, will you look, I don't know how much of equity value is out there. And more importantly, what about Dalmia Bharat? How do you see this one placed? If it gets most of those assets, you can easily see the capacity go by 10-12%.
It appears like that. In fact, Nigel, of course, I haven't analyzed the potential deal here, but cement in general has been looking on an uptrend, at least in the stock prices. And I think much of the decline that happened towards most of the end of last year and the beginning of this year has kind of been recovered. But we're seeing that majorly in ACC and Ambuja, but the rest of the pack is only starting or midway into the recovery stage. So is Dalmia. So if you were to look at this JP deal, what will be left behind after this with JP is suspect. I don't think there'll be much left there anyways. So I wouldn't bother with that too much. It will be interesting if Dalmia is the buyer, or if any of the other guys are buyers, to see whether their integrations will work well with this. Like you said, there's not everything that comes in. It's not a fully integrated plant. So you'll have to have some capacities close by. We haven't analyzed geographical issues over here yet. I think I'll wait for the announcement before we look at it. But honestly, in cement-wise, I think the players really are the top three. ACC, Ambuja, Ultratech are pretty much where you should be playing most of your plays on cement right now.
Deepak, do stay on. The other sector that we would like to discuss are the technology names. So the Nifty IT index, a representative of all the technology names, was down 3.5% on Friday, the index. It's followed it up with another 1% knock. So as of now, at least, the bottom has not been formed in the IT names. The news flow, of course, has been the street is worried that in Q3, we are going to see higher than expected furloughs. Furloughs are the mandatory leaves that, people take. Most of the banking companies have those block leaves. Factories shut down on account of seasonal factors because of the Christmas season, etc. But this time, due to demand slowing down, companies may opt to shut down their factories, close down their offices for longer. And this is going to hurt Q3 revenues of IT companies. HCL Tech has already warned that growth is going to be at the lower end of their guided range. Brokerages are bringing down the revenue estimates by nearly 50 basis points. And the stocks, of course, have seen a sell-off in the last 2 days. Early today, we had a chat with the management of HCL Tech to understand this guidance warning that they have given, what they had to say about the deal wins, etc. And we also asked him that, is this an HCL Tech specific issue, or is this something that we may see with the rest of the IT companies, the industry per se? Listen into what they had to say.
It's maybe 3 or 4 clients in these verticals. That's what I would say. However, one should keep in mind, we did talk about the bookings, we expect to have a decent booking. The deal momentum is very robust, especially the vendor consolidation and the cost efficiency led deals. Currently, our guidance is 18 to 19% for this fiscal, but our aspiration is to get back to the 19 to 20% range as we move forward. So good deal momentum and good progress on all the cost levers that we have been working on. No, I mean, half the year is over. You know what the first half margin profile was. We will do better in the second half. We had a good benefit of realization in the last 6 months based on all the billing rate enhancement that we were driving. But moving forward, I think getting increases may be difficult. But I expect the pricing to be stable because still for some niche skills and some of the newer skills, the demand is quite high. So I think the pricing, I expect it to be more or less stable as we move forward.
Okay, price increases may be difficult going forward. Deepak, your thoughts on the IT names, the sell-off that we've seen. Now, take a look at HCL Tech. In the last 2 days, HCL Tech has fallen close to about 7 to 8%. Now, while the cut in the top line is close to about 50 basis points, 60 basis points by way of a revenue cut compared to what the street was anticipating because of this guidance. Is the stock price now adequately pricing in what we are likely to see? And what about the rest of the pack?
No, I think, Riba, we've seen these stocks go up quite considerably last year. Their average PE ratios, let's say, were 14 or 15. They went up to 25, 30. Some of the mid-caps names still quoted 50 or 40 times. So there is a healthy correction in some of the estimates in terms of the forward PE ranges also, because I think earnings are going to slow down, at least for 2023. 2022, FY23, that's till the first quarter of next year, we are going to see some kind of issue with respect to past contracts, yields either slowing down or not realizing as much as expected. And but new deals are being struck. The rupees at 82, so there's a bit of because the rupee rate will impact largely the new deal. So they may not be able to get a price increase, but in rupee terms, they'll get a little bit of a bump up because of where the rupee stands today. The other thing is, of course, the new deals that will come, the largest of them will start coming in towards the end of the first quarter of next year, which means March, because budgets can start getting set in January, and then deal wins will start happening in end of March of next year. So we expect those earnings to start reflecting only in the mid of 2023, which is June or September of 2023. We'll see that start to trickle in. So I would say right now is a time for consolidation. The earnings could correct even more. Prices could correct substantially higher from here because markets look at really short term when it comes to immediate stock prices. But by the middle of next year, they should start to improve again.
No, absolutely. Deepak, hi, afternoon. One sector which is not seeing very much consolidation, but just seeing moves is PSU banks. They say momentum begets momentum, gains beget more gains. And I guess that is what is happening here in this space. Actually, from the time that we started, the PSU bank index has moved up sharply higher. I think there was about 0.8% gains. We are up 1.4% on the PSU bank index, and this is all coming through, from 230 on. So that's a very, very sharp move we've got on our hands. Any thoughts, Deepak?
So we're invested in a bunch in our momentum strategy itself. As you said, there's a lot of momentum in there. There is, of course, some fundamentals that drive it. Credit growth is at 17+%, which is higher than pre-COVID. We're also seeing parts of the early stages of inflation, the early stages of interest rate rises actually causes more credit growth to happen. It's only when interest rates start to peak or go much higher does credit growth slow down. So in the early parts, I think the PSU banks stand to benefit. The private sector banks are still a little wary of growing anything more than they're growing currently, which is about 17 to 20%. The PSU banks were not doing that at all. So they're priced at, even now, less than 1x book. However, the growth in credit is a little scary because in the past, whenever the credit has grown at a fast pace, NPA development in a 3-year vintage, 3 years later, tends to be very high in PSU banks. So even with this consolidation of PSU banks, merging the bad banks together, are we seeing a situation where maybe more bad banks come into play 3 years down the line? Also remember, a huge amount of new equity has come into these banks by the government adding in more cash. The government itself will have to divest some of that eventually. So I think we shouldn't look just at past prices, saying that it's reached only 50% of its past price or 40%, because the market caps are much higher given the larger quantity of shares that are currently in issuance. However, I think it's a good party to play in the early parts of the credit cycle. So hopefully it will continue for at least 4 or 5 months more. I would look at it only as a very short-term trade rather than it being, core fundamental right now.
Okay, maybe a bit of a tactical play, and it has some more legs maybe for the next few months is what Deepak believes. Stay with us, Deepak. Well, before we slip into a short break, a few of these stocks are flying away. J&K Bank, well, we had the management that joined us, last week, and they sounded very optimistic. That stock has spiked to the high point of the day. And Suzlon's the other one that is locked with a gain of close to around 10%. Slip into a short break. On the other side, we'll get chatting.